All right, before we begin, Micah, can you provide a quick audio check for me? Just a thumbs up would
Yes,
be
you
great.
are good.
All right. Well, good morning, everybody, and thank you for sharing some time with us this morning. When we scheduled this meeting all the way back in November, the idea was that we were going to talk to you about what was happening in an intense and busy farm bill debate. And as you know, if you've been following the news, there hasn't been one yet. So instead, we're going to talk about some of the players, some of the parameters, and what we know so far. It's our expectation that the Farm Bill debate will start to shape up in earnest sometime in February and March, with the committee chairs on both the House and the Senate side indicating that their belief is that a farm bill that's presented to the floor of the House sometime in September is their best shot at getting it done in time for the expiration of the current farm bill. So we know that there are some steps that have to occur between now and then. We're going to talk about what some of those steps are, what some of the major factors that will play into those decisions might be, and where we can expect that debate to go. But at this point, there hasn't been much in the way of formal hearings, and most of the action is happening well behind the scenes. So we may give just a quick peek behind the curtain to get a sense of what that debate looks like at this point. But at this point, it's going to be very early to predict what sort of components the next farm bill will include and what it will exclude. So we'll try and provide a little insight into what we expect at this point. And then our primary message is going to be stay tuned. Here are the things to watch. So given that we don't have as much farm bill information as we hoped we might, we're going to spend some time on some other topics today to try and provide something useful as you get ready to make some important decisions over the course of the next 60 days. So I want to start just with a quick introduction. My name is Alex Offerdahl, and I work with Watson Associates. And a big part of what we do is working with some of the decision makers, particularly the staff of the committees on both the House and the Senate side, providing some insight and some behind the scenes math to give them a sense of what programs will mean what for which producers. As you're aware, our commodity title and our crop insurance title are two of the biggest parts of the Farm Bill. And as each of the different constituencies ask for policy changes, it can be difficult to predict what those policy changes would suggest in terms of how much the program costs and if farmers in one part of the country would benefit at the expense of farmers in another part of the country. So our primary role in helping with the Farm Bill is to look at the policy proposals and provide the best guesses we can based on the statistical information that's available, which commodities and which producers will benefit from a new program and which ones may find themselves preferring another program instead. Particularly over the course of the 2014 and 2018 Farm Bills, the commodity title has been based around two programs, ARC and PLC. And we'll hit on those a little bit. But the two program choice that we've come up with over the recent years is based in no small part over analysis that showed that some producers would benefit tremendously from ARC, others from PLC, and having only one program would certainly be Congress picking winners and losers in the Farm Bill. Now, they're not afraid to do that, but it's something that they generally try to avoid. And we wanted to talk to you a little bit about how some of those choices get made. So today, we've got a pretty ambitious agenda for 40 minutes. I'm going to go fairly quickly, just hitting on a few things that I hope provide a little insight into some of the hard choices that you're going to be making over the next 45 days in particular, and then a little bit of implication on some of the things that you should be thinking about as we watch this Farm Bill debate play out. I want to start with a quick look at the markets. Most of us are already deep into a point where we're thinking hard about sales of a crop that we won't plant for a couple months yet. And in particular, I want to talk about what's been happening with the corn and the soybean futures markets. Last fall, going into harvest, something kind of unusual in a historical sense happened, and that is that markets actually were increasing as we got closer and closer to harvesting that crop. Often, during the harvest season, there's pressure just based on the supply coming online with the new crop on those markets, and it's very seasonally typical to see those markets fall off. But this last fall, that's not what we saw. So this is a look at the new crop 2023 futures market for corn off the Chicago Board of Trade. And as you can see throughout that harvest season, if you can see the mouse cursor tracing it up, we saw unusual seasonal strength into that market. And for a lot of the early part of winter, the market just sort of hovered around this 625 time the space. Subsequent to that, we've seen the market sort of slowly slide, and that's been particularly pronounced since around the new year, where we've seen pressure coming on as the South American crops, which look to be just absolute monsters, are harvested and just demonstrate just how many acres and how much production is there. Micah, I saw that a hand was raised, so if you'd like to use the chat, I'd strongly encourage you to do that. Micah is our moderator, so I'm going to have to depend on him to pull through any questions or comments that you may have. I also want to talk a little bit about the soybean market. It also rallied through the U.S. harvest season and showed strength against a strong seasonal trend for lower prices, and it held up very well throughout most of the winter. But here in the last few weeks, we've seen the soybean market test some downside pressure. We've lost over 80 cents in the soybean market in just the last few weeks. And while we had a couple of days of positive market movement that helped recover some of those losses, you'll see that this market actually gapped lower a few days ago. And when we're talking about gapping lower, that means that the market open on the following day was below the prices that had been achieved at any point in the previous day. That tends to indicate that the market is looking for a price that falls outside the bound of expectations on the previous day. And generally, when your markets gap lower, that's bad news. But you can see that the market has managed to find a bottom, at least temporarily, and actually recovered a bit from that, filling in that gap yesterday. And in a little bit of quiet overnight trade is actually still well within that previously tested range. So what do we see? Well, the corn and soybean markets are both a bit lower than they had been in previous months. And that's particularly important as we get to turn the calendar over to the month of February. The reason for that is that any of the market closing prices from the Chicago Board of Trade that are recorded in February are used to set our crop insurance projected prices, those guarantees that are going to be critical for our planning decisions for our farms this season. And we're right on the edge of starting to make some of those determinations for those crop insurance prices. So I want to talk a little bit about what the markets are implying now and what that could mean for your crop insurance. Particularly if you're buying a revenue-based policy, crop insurance is a very useful tool that you can use to forward market with confidence. A couple of weeks ago, I was privileged to attend the Farms Conference in Indianapolis, and there we had a room full of about 45 producers who were all talking about ways that they could use tools, futures, options, and crop insurance to put in a floor and assure themselves some security going into the next crop year. And there, while we were discussing this topic, I shared a story with them. So if you'll bear with me, I'll share the same story with you. So there's this farmer out in the field, and while he's there, to his intense surprise, he digs up a lamp and he rubs the lamp. And as he rubs it, to his even more intense surprise, a genie emerges. And the genie says, "You know the deal. I'm the genie of the lamp. Give me 3 wishes and I will grant them for you." And the farmer, without a moment's hesitation, says, "I want to grow 300 bushel an acre corn." And the genie says, "Granted." He says, "I want a corn price of $7 a bushel." And the genie says, "Granted." And then he pauses, and the genie finally asks, "So what's your 3rd wish?" And he says, "I don't know. That's all I ever wanted. I'll save the 3rd one." A year later, the genie emerges from the lamp and finds the farmers rubbing it absolutely furiously, and says, "Okay, have you decided? What's your 3rd wish?" And the farmer says, "I want $7 corn." And the genie says, "I granted this wish. You had $7 corn last year." And the farmer said, "Yeah, but this time I'm going to sell it." I think that a lot of times we find ourselves in a situation where when the market does provide us opportunities, it's very difficult to pull the trigger. We find ourselves in a situation where when the market is trending up, it's hard to reward the market because it means that you believe you could miss out on the peak. And when the market's trending lower, it's hard to think about the prices that you could have had, but those opportunities have sort of slipped between your fingers. So crop insurance is a great way to put in a floor and allow you to market with confidence. As it turns out, very few farmers are actually using futures and options, but every farmer is making cash sales. And crop insurance, as we discussed at great length, and as any of your Farm Credit Mid-America crop insurance agents would be happy to walk through with you, is a tool that can be used, particularly at this time of year, while we're getting ready to set up projected prices in the next few weeks, to lock in a floor and to provide you some assurity if you're going to forward contract your crop, that even if prices increase subsequently, you'll be covered because crop insurance will help make up for any shortfalls. In fact, dollar for dollar, make up for any shortfalls if you're contracting up to your crop insurance guarantee. So let's do just a really quick review of how your revenue insurance policy works. And again, your Farm Credit Mid-America crop insurance agent is one of the foremost experts in the country on how this works, and we'll be thrilled to walk through this with you. But as we discussed, your crop insurance policy is based both on your historical yields, subject to a bunch of adjustments that can be made, and your agent will talk those through with you. But it's also based on the higher of the February or October price pulled from the futures market. I think some of us watch the futures very closely and others just see it as background noise, but here is one place where it absolutely has a lot of applicability to our decision-making process, because it's that futures market that's helping to shape up exactly how our crop insurance guarantees will operate. And for a lot of us, that guarantee is the thing that gives us the assurances we need to forward market at least a portion of our crop. So producers choose a coverage level, which is the same as sort of setting their deductible. Let's go through a quick math example. So your insurance guarantee is calculated as your approved yield times your coverage level times the greater of your projected harvest price. And that greater of projected and harvest price seems like the sort of thing that shouldn't matter very often, but let's take a quick look at what it meant in 2022. There we had a 200 bushel approved yield. And I think for a lot of the region that we're talking to today, especially on the northern part in Indiana and Ohio, there are a fair number of places where a producer's approved yield, their historical yield with some trend adjustment and other things, could be 200 bushels. It certainly makes the math easy. And then 80% coverage level, which was the most popular coverage level in Indiana and Ohio last year. So those two components get you your number of bushels you could forward market, but those are applied against the greater of the projected price and the harvest price. The February price was $5.90. The October price was $6.86. So that means that over the course of the year, producers' insurance guarantees actually increased substantially. Last year, people who bought a 80% policy and had a 200 bushel APH, or approved yield rather, had an almost $1,100 insurance guarantee. So at the same time, during harvest, as prices were running up, insurance guarantees were running up right with them. In the spring, producers thought that their insurance guarantee was just going to be that $5.90 multiplied by their approved guaranteed yield, or $944. So producers gained more than $150 of coverage just based on this feature. And that turned out to be very important for some producers who faced some yield circumstances that went against their will. In fact, let's do a quick example. This is an example that we pulled from DeKalb County in Indiana just yesterday. A producer ended up harvesting 140 bushels. That was applied against that harvest price of $6.86. That means that producer's revenue based on that harvest price and that very disappointing yield was $960. That meant that producer received $137 an acre indemnity for that disappointing yield. And you'll note that $960 that they got for their yield because of that run, or for their production based on that higher price, is actually greater than what their guarantee was last spring. So crop insurance is doing its job. It's resetting based on the actual value of the crop at the time of harvest. And that is the sort of thing that can allow you to forward market with confidence, even if you're concerned that the markets may increase over the course of the crop year. So let's talk just a little bit about crop insurance writ large. And I think this is going to be an important part of your considerations as well. 2022 was a remarkable banner year for crop insurance. It blew the doors off of all historical records for participation. Crop insurance, as you know, is a very heavily subsidized product. That means that the federal government pays about 60 cents of every dollar that's paid for premiums. That's done very intentionally as a part of farm policy. And we'll circle back to this when we talk about the Farm Bill again. And that also means farmers are making a big investment of their own dollars in supporting these programs. In fact, in 2022, producers spent more of their own dollars to participate in crop insurance than they'd ever spent before. Out-of-pocket expenses for producers for crop insurance last year were over $5 billion. That means, for context, that producers paid more dollars to participate in crop insurance than they received from FSA for commodity programs or conservation programs combined. So if you've got a program that is a federal support program designed to assist producers that requires producers to pay dollars out of their own pocket, and they do so at a record level, that is producers voting with their checkbook to say, hey, this is a valuable tool. And even as producers were spending more money, the federal government was standing beside them and matching those investments with record investments of their own. So as you can see, producers are finding a lot of value in crop insurance, and a lot of that is coming from two things. First, producers are buying higher coverage levels than they ever have historically. And second, because our markets have been so volatile and relative to historical prices, our prices have been relatively strong. Those things have pushed up liabilities and premiums. But despite the higher cost of crop insurance, producers are buying more of it than they ever have. So at some point over the last couple of years, producers have gotten savvy to the screaming deal that crop insurance offers for them. And I think this chart helps to tell that story. So the lower blue line that you see here is the total dollars of premium that are paid in and the total dollars of indemnity that are paid out. So the ratio of indemnity to premium is that lower blue line. And on average, it hovers right around 1. That means $1 in equals $1 back out. But remember that 2/3 of the dollars that are paid in the form of federal subsidy. And in the long run, these are just national average charts. For every dollar a farmer pays for their crop insurance, they get about $2.12 back out. And that's just how subsidy has worked historically. So how many investments out there are that are paying a 212% positive return on average over a 35-year period? Crop insurance is one. The other thing that we know about the 2022 crop year in particular is it's going to be the second biggest indemnity year ever. It was the biggest participation year of all time by a lot. But despite what was for a lot of the country a pretty normal year, and a year where prices went up rather than went down, the drought that occurred mostly to the west of you and some other risk factors mean that there were widespread losses in the program. There are going to be about $15.5 billion in indemnities paid out this last year. So not only are producers finding value in the cover that's provided, the indemnities are really shaping up to be an important part of the farm economy, particularly when our programs like ARC and PLC have performed so poorly over the last couple of years, have offered so little in the way of support. So let's talk a little bit about not just the crop insurance choice that you're going to make between now and March 15th, but also your FSA election for the ARC or PLC programs. Now, theoretically, you should be getting all of the information you need from your local county FSA office, but I do want to provide you just a little bit of insight and share with you a tool that's available from your Farm Credit Mid-America crop insurance agent. So in the last Farm Bill in 2018, USDA harmonized or made the same the enrollment dates for crop insurance, March 15th is the deadline, and the enrollment dates for the ARC and PLC programs with FSA, which now also have a March 15th deadline. But at the same time, they also put a new burden on you. And over the last 5 years, you've been compelled as a landowner at FSA to enroll in one program or the other. So let's quickly contrast them. And these slides are going to be made available to you. FSA also has good information. And of course, your crop insurance agent is an expert on this stuff. One is ARC. An ARC is like a area or county revenue program. It protects you from a reduction in yield and price together. On the other hand, the PLC program is designed to protect you purely from losses in price. And it's not losses relative to the price last year or the year before. It's instead relative to a benchmark price that was fixed all the way back in the 2017 debate for the 2018 Farm Bill. We're going to talk about this when we get deeper into the Farm Bill side, but the bottom line is the prices that were set for crops that you care about in the Farm Credit Mid-America country are well below where the markets are today. So as a result, neither of these programs has been very attractive. Over the last couple of days, I worked pretty hard to come up with a scenario where I could get one or the other of these two programs to pay. So this is a tool borrowed directly off the website from the Farm Credit Mid-America folks, where we looked at that ARC versus PLC choice. This tool is populated with all of the county level information for the benchmark. ARC is based on a 5-year Olympic average. That means that we drop the high and the low and average the remaining three. So let's look at exactly what those 5 numbers would be, and we'd know immediately what the high and low would be. And then we enter in our guess for what the yield for that 2023 crop we aren't even going to plant for a while yet will be, and where the price will end up. And in order to get a payment for either program, I had to put in a final yield of 145 bushels. And at 410, I still wasn't low enough to trigger a PLC payment. In fact, that price would have to fall below 370 to trigger a PLC payment. So what does that mean? Do I take ARC or do I take PLC? Well, the answer is very likely, unless something pretty catastrophic happens, neither ARC or PLC are going to provide you very much in the way of expected coverage this next year. So if you are counting on those programs as an important part of your risk management strategy, it's probably time to take the ball in your own hands and instead use other tools, whether that be forward marketing or particularly crop insurance, to take some of that risk out of your equation. From here, I'm going to shift gears a little bit and talk about another consideration that if I were you, I'd be thinking pretty hard about, and that is the 90-day forecast. Now, 90-day forecasts are notorious for being very difficult to predict. And you can see that the level of precision that's included in these forecasts is not very high. They make predictions like, we think there's an above average chance or a much above average chance that a tendency will occur. But I want to draw your attention to two different things. First, in the area that we care about here in Farm Credit Mid-America, we're looking at what looks to be an early and relatively mild, from a temperature perspective, spring. As we go into that March, April, May time period where we're getting ready to plant the crop, or in some cases we'll be planting that crop, we're looking at above average temperature conditions, which should be pretty friendly to planting. But we also have to consider the fact that they're looking at much above to much above normal precip in that same corridor. And heavy precipitation that makes it difficult to get into the field. I also snuck a quick look at June, where they're also predicting well above average precip, can create problems of its own. Trying to plant in the mud is just no fun at all. And in some circumstances, we find ourselves actually prevented from planting. So while above average temperatures may give us an early shot at the field, it's going to be probably chasing windows without a lot of precip to get that crop put in. And that means we have to deal with another risk, prevented plant. It's been a couple of years since we've dealt with it throughout a lot of your region, but those of you, particularly in parts of Indiana and Ohio, who dealt with it in 2019 will recall, prevented plant situations are a real risk for the farmers that we care about. And while I like to talk about revenue-based crop insurance as a great tool for forward marketing, it has a gaping hole in it that you need to know about. That is that if you find yourself in a prevented plant situation, you do not get that greater of the projected or harvest price coverage. Instead, you get a prevented plant payment. Now, you are saving yourself the expense of planting, but this is how a prevented plant payment would be calculated. Using yesterday's futures price, which is around 590, you multiply that again by your approved yield and your coverage level, but then you apply to it this prevented plant factor. So rather than the producers in 2022 who ended up with a crop insurance guarantee of almost $1,100 in a similar situation, producers who are prevented from planting received a payment of $566. So let's be honest, that's way better than a poke in the eye. But relative to the guarantees for those producers who got the crop planted, or particularly those who made commitments to make deliveries at harvest time at the same time prices were going up, a prevented plant situation is something we have to keep a close eye on. And that's why we look so closely at those seasonal weather forecasts to understand what sort of risk could be coming your way. And again, your Farm Credit Mid-America agent is prepared to talk to you about exactly what that means. From there, I want to talk about a couple of other things that have been on the radar, but haven't done much in the news yet that I'd like for you to think about. And one of those is we had yet another outbreak announced very quietly by USDA's APHIS, Animal Plant Health Inspection Service, yesterday about another depopulation event for high-path avian influenza. And even if you don't have feathers within 50 miles of where you live, which is frankly a little unlikely, there are egg operations in particular in nearly every county in the United States with meaningful agriculture. And that means a lot of the territory that we talk about. High-path avian influenza has absolutely decimated our laying hen herds. It's not been easy on the turkeys. It's not been easy on the broilers. And I wanted to show you this map where USDA has found in wild birds positive tests in every single state. And in the states that we care about, they found a lot of them. So migratory waterfowl primarily are the vector that we're talking about here. And also, just to add to our risk factors, there are now been 3 different separate incidences where we found humans contracting high-path avian influenza. So that will have a couple of important implications for us. One is that eggs are stinking expensive, well beyond where we've been with inflation. This chart's just showing that we are down a bit so far in 2023 from the most recent data that we've got available. But we're also historically incredibly high for egg prices. Part of that is a result of USDA coming in and depopulating, their chosen euphemism for what happens when those birds that are infected have to be destroyed. But the other implication is that poultry feedstocks are a big driver of demand in some parts of the country for the corn and soybeans that we grow. If there are fewer birds, particularly if there are sharply fewer birds, then that source of demand goes away. And that means that some portion of what's contributing to the prices that we have been enjoying also goes away with it. So it's worth keeping in mind that this egg situation and high-path avian influenza is something we're going to have to keep a close eye on. We're in January. Historically, when we've seen high-path avian influenza break out, whether that be in 2017 or even the last couple of years, it's occurred during the warmer parts of the year. So seeing this occur in January is certainly something that's on our radar. It could be a very nightmarish season if we don't get our hands around this thing pretty quickly. Another thing I want to put on your radar that you might have heard about is the ERP, the Emergency Relief Program. Phase 2 was announced, and your FSA office should be providing you with additional information. Most of you who participated in revenue-based crop insurance this last year have already received some form of payment for losses if you were eligible under the first round of ERP payments. It was all calculated directly off of your crop insurance data. You probably received a very simple form from FSA, filled it out and returned it, and it's very likely that if you did and you were eligible, you've already received a payment. In the last week and a half, USDA has released a second round of this, and it's designed specifically for producers who did not receive payment in the first round, but did find themselves suffering from eligible losses. I know this is about the 6th or 7th random program released by USDA for emergency relief over the last 5 years, and it's been very difficult for a lot of producers to keep track of them, particularly if your county office has suffered some disruptions or closed even temporarily for things like COVID. So this has been a difficult thing to track. But I would draw your attention to the fact that there are counties in the Farm Credit Mid-America area where ERP2 eligibility does exist, and it's worth monitoring, particularly if you felt like you had an eligible loss, it did not receive an indemnity or a payment from the first round. So again, please check in with your county FSA office, ask about it, and if you're eligible, please look forward to participating. The first sign-up dates are coming up rapidly. So from there, with about the 10 or 15 minutes that we have remaining, I want to talk to you a little bit about what we do know about the Farm Bill. On the open, I discussed pretty frankly that there's a lot that we don't know. We've had exactly one meeting of folks that are looking to discuss the Farm Bill, and this is a photo of it. This was an informal discussion session held at the Harrisburg Farm Show in Pennsylvania a week ago Saturday. There have been no committee hearings because the committees haven't been fully formed. On the House side, the Republicans have been announced, but not the Democrats. And on the Senate side, the opposite is true. So before the committees are formed, and they're reforming themselves and shuffling a bit right now, it's difficult to have a hearing, but there have been some announcements for scheduling. So today I want to make it very clear that I'm going to spend time talking about policy and what it is we expect to see, but I'm going to avoid any discussion of the politics. I don't find it's terribly useful right now. And moreover, historically, crop insurance and farm bills as well have always been very bipartisan. So talking about partisan breaks or what one party wants and another doesn't want is in a lot of cases not as useful as talking about where we see the policy shaping itself. I'm not going to talk about that, so we're going to focus on this. So let's start with the House Ag Committee. Here on the chair side and on the ranking member side, we've got a very experienced hand. Congressman Thompson has been on the Ag Committee for a long time. He's well respected on both sides of the aisle. He's from Pennsylvania, so it's kind of nice to have someone not that far from our region chairing the committee. Congressman Scott is from Georgia. He was the previous chairman, and as the ranking member, he also brings a lot of experience to the committee. But when it comes down to it, the bench just isn't that deep in terms of experience. So I want to start with some members of the committee who are coming back from the last Congress. And I've highlighted the names of all of those committee members who were part of the committee the last time we did a farm bill. You can say the list isn't very long. There are only a few folks who sit on that House Ag Committee who've actually participated in the creation of a farm bill before. These are some other ones that are returning, but weren't there the last time there was a farm bill. And to strengthen their bench, Congressman Frank Lucas, who was actually a past chair of the House Ag Committee, was put back on the committee recently to help with the farm bill creation process over the next couple of years. And then these are the rookies. These are folks that have never sat on the House Ag Committee at all. And this is just the Republican side of the roster. We'll get more information on the Democrat side of the roster here in the next little while. But the bottom line message here is there just aren't a lot of folks sitting on this committee who've written a farm bill before. And it will take them a little time to find their feet and understand how that process works. As much inexperience as we see on the House side, the opposite is true on the Senate side. The Senate side is led by and composed of some very experienced leaders. Senator Stabenow will set a record this year as having written 4 farm bills and certainly knows where the bodies are buried and how this process works very well. Senator Bozeman from Arkansas is extremely well respected and well liked on both sides of the aisle on ag issues and can be expected to advocate strongly for Southern crops, particularly crops that are important in Arkansas, Kentucky, Tennessee, Mississippi, Louisiana, that part of the world, but also just to sort of understand how ag policy goes together and what factors might be important for producers. He also served for a long time in the House. These are some experienced folks. Yesterday, 2 new rookies were named to the Senate Ag Committee, both on the Democratic side. Senator Welch, who replaced the venerable and legendary Pat Leahy from Vermont, is added to the committee. And then another rookie, Senator Fetterman, was also added to the committee yesterday. So the Farm Bill is made up of many pieces, and we're going to spend most of our time talking about just a few. But this is the plan when the 2018 Farm Bill was passed for spending. And as you can see, more than 75 cents of every dollar that was intended for spending in the Farm Bill was for nutrition programs. Most of that money is for the Women, Infant, and Children program, the Supplemental Nutrition Assistance program, and for school lunch and other sort of childhood nutrition type programs. And that's where most of the money goes for. The 3 other bars, the orange, the white, and the green, are the parts of the Farm Bill that go to what we would consider to be more conventional support for production agriculture. And here we can dig deeper into the numbers, but the most important story is that Congress intended for most of the support for agriculture to come in the form of crop insurance. That's far and away the biggest portion of the producer supporting aspects of the Farm Bill. We start with the ARC and PLC program. Those are the primary pieces of the commodity title, and they're supposed to cost about $6 billion a year. In recent years, they've cost a fair amount less than that. And the reason is because the way those programs were designed, there haven't been much in the way of payments for ARC or PLC in recent years. So the commodity title is the first title of the Farm Bill. There again, it's ARC and PLC, and we've talked about how these programs work. You will have to enroll for one or the other of these programs if you choose between now and March 15th. But the critical piece that I wanted to share with you is how outdated the expectations for reference prices are. The reference price for corn is $3.70. The reference price for soybeans is $8.40 and wheat is $5.50. If your costs have looked anything at all like those of your neighbors, these prices are well below your cost of production. An ARC or a PLC payment that triggers based on these sort of prices is likely going to be useful to no one except your auctioneer, as unfortunately, they're nowhere close to where we are with production prices. A huge portion of the Farm Bill debate that we're looking at is probably going to be a debate around where we reset these prices and at what levels make sense. But I will also tell you that as these prices get increased by policy, that can be a very expensive thing. And how the Congressional Budget Office, who makes predictions about the cost of a Farm Bill, perceives these will be incredibly important as well. So there's the conservation title next and the nutrition title where most of the money ends up getting spent. And then I just wanted to point out for you that there are a bunch of other titles, but that they don't add up to peanuts against the overall cost of the program. So crop insurance is the biggest piece of this program. Looking at how spending was expected to weigh out against how spending actually has weighed out, particularly with huge increases in the cost of nutrition as recent inflation and COVID have driven up demand for those programs. We spent almost 150% of what we expected to on the last Farm Bill, and that will weigh very heavily into the debate as we go forward. Here's a listing of some of the topics that are being discussed in the Farm Bill, but again, it's very early and it's difficult to predict how that will all shake out. So with that, I want to turn things over to our partner, Chase, who's going to talk a little bit about what this means to you and where we go from here with this information.
Great. Thank you, Alex. It's always great to hear your expertise on these more complex topics. I'm here to wrap up the webinar here for us all this morning. I just want to highlight a few items on how your local crop insurance team's here to help. We at Farm Credit, we're committed to your education as the producer. Our goal is to provide the most value possible by making sure you are aware of any changes that could affect your operation. The decisions you make regarding government programs and also on your crop insurance policy. It is our goal to provide you with the tools in order to make data-driven decisions. Alex showed the ARC PLC tool, which may not be a real important tool for this year, but in come time it will be. We can't stress it enough to revisit your policy on an annual basis. And remember that what you did last year is not always the best plan for the following year. So please make sure you look at that every single year at renewal time. We take great pride in being your trusted advisors from start to finish. From different crop insurance policies to any program at your local farm service agency, we are here to help you make the best decision possible for your operation. With that, be on the lookout for upcoming webinars we will offer throughout the year. I know Micah and his team, they do a fantastic job and offer those throughout the whole year. And also local grower meetings in your area coming around the corner. We'll hear more about the new Farm Bill this year, and there will be plenty for us all to learn. So we want to include all of you in the sharing of that information. And as you'll see on the next slide, the next 40 days are going to be extremely important. First and foremost, obviously your crop insurance decisions are due to be made by March 15th. I recommend contacting your crop insurance specialist as soon as possible, just to make a sound decision and you're not rushing and pushing that March 15th deadline. Like Alex mentioned here earlier, the new Farm Bill will begin making progress at some point, and we hope to know much more in the next couple months. So be sure to follow that information and ensure you are prepared for any changes we might see. Lastly, just like Alex said, you must enroll in government programs by March 15th. ARC PLC are now made on an annual basis and have the same deadline as your crop insurance renewal. Many customers are carrying the SCO endorsement on your crop insurance policy, So if you are one of those producers, please keep that in mind as you make your government program elections this spring. And with that, I just want to
Okay,
thank
so
all of you.
can we pause for just a second? Because you said something very important that we should probably make clear.
Yes, sir.
If you choose to participate in the ARC program, you are not eligible for the supplemental coverage option or SCO policy. So as we discussed, at this point, it doesn't look like either ARC or PLC will provide much protection for you. But if you choose one of these programs, ARC, you're ineligible for a program supplemental coverage option that could provide that protection. So I just want to make it clear that these conversations about farm bill elections and about crop insurance are not independent anymore. And that's why it's going to be important to work with someone like Chase to talk through the implications of those choices. Good point.
Thanks, Alex. With that, I want to thank everyone for attending. It looks like we have close to 160 producers on here, and we greatly appreciate you taking time out of your morning to join us. A huge thank you to Alex for sharing his insights with us as well. Alex is a huge resource for our team. We greatly appreciate every time he chooses to spend with us. Please reach out to your local Farm Credit office with any questions you may have. We wish all of you a successful 2023, and please know that our entire staff here at Farm Credit Mid-America is here to help you. Thank you.
Awesome. Thank you, Chase. And at this time, we are going to open it up for any questions that you may have. I know that I had one that was sent over here to me individually. And so as you bring up those questions, feel free to chat those in if you would like. Alex, I don't know if you're going to have any thoughts on this, but a customer asked about, do you think they would consider any future tax changes for farmers within a farm bill? Is that the space to have that discussion?
So that's actually a great question. And as wild as it sounds, there's been some discussion about that. So I'm going to separate tax policy considerations from programs within the Farm Bill that have tax implications. Okay. So theoretically, taxes fall under the responsibility of two different committees. One is the Budget Committee, who's going to have a pretty important voice on just how much we end up spending on the Farm Bill, particularly because we completely obliterated our budget on the last one and spent almost half again as much as was in our original budget baseline. And then the other part of that is the Ways and Means Committee. Now, as it turns out, the new chairman on the House side of those are both folks with strong ag interests themselves. The Budget Committee chairman, Jody Arrington from Lubbock, Texas, is a cotton farmer himself and is tremendously interested in farm programs. So if we were looking for someone to really drag hard on the purse strings and limit our capability to spend on a farm bill, having a Budget Committee chairman who is as aggy as anybody is probably good news for us. And he's particularly interested in some of the southern crops, and cotton will definitely get theirs, but it does appear that that is good news. On the other hand, the congressman from Missouri, who chairs the Ways and Means Committee, is the one who has primary responsibility for taxation. And I think he would argue strongly, again, an Aggie himself, a ranch kid from Missouri, is going to have some tendency to support overall agricultural needs, but is also going to defend the territory of the Ways and Means Committee to have responsibility over taxation. And given recent budget deficits from two consecutive extremely spendy administrations, you can look for the House to probably try and instill a little additional discipline into that process and let folks like Ways and Means and Taxation on the Budget Committee be principally responsible for changes to taxes. That said, every farm bill touches taxes one way or another. And one of the proposals that we've seen quietly floated by a couple of different producer groups is what they're calling a farm savings account. And this would be a bit like how an IRA or individual retirement account functions, where producers in good years would be permitted prior to taxation to contribute a certain amount of money up to a set of limits that would be usable by them in a poor year, tax-free. Now, is that tax policy? Is that tax changes? Well, the answer is yes, sort of. It's a farm program setting up an individual rainy day account that would allow them to later pull from it, farmers funding it themselves and potentially enjoying some sort of match or subsidy on that, and then pulling it out later tax-free. I know a lot of us manage our taxable income by how we arrange for our pre-purchase of inputs. And December and January, based on where we were with the previous year's revenues, a lot of us decide, okay, do I book these purchases on December 28th or do I book them on January 4th to manage which tax year that those fall into? And the idea is that these tax accounts would take some of the pressure off of that intense planning period in late December and early January, and instead say, in a good year, I'm able to set aside a portion of those dollars in a rainy day fund, tax-free or tax deferred at very least, and then in a poor year where I really need the revenue, potentially pull it back. So I know that probably only kind of answers your question, but that is the latest that we've heard in the debate at this point.
Awesome. Well, gentlemen, that was the last question that I had come through. And so thank you so much for your time. For those of you still on the call, this recording will be sent out to all producers that registered for this event following this webinar. And so over the next week, you can expect this to be found on E-Farm Credit. And we thank you so much for joining us, and we'll see you next time. Thanks, Alex. Thank you, Chase. And I appreciate your time.
Thanks, everybody.
Yeah.